All right, let's get right into it. Today, we're taking a trip way up to the Tibetan Plateau to do a deep dive on a fascinating new IPO, Zhihui Mining. The big question is this high-altitude operation a hidden diamond, or is the risk just way too high? We're going to break down the business, dig into the risks, and look at the final deal to figure out if this is an investment you should be making.
So let's start with this quote, because it really just nails the whole story. Think of these guys less as miners with pickaxes and more like the masterminds who own the exclusive treasure map to a chest buried deep under the snow. They don't do the digging themselves, they outsource the tough stuff. Their job is to process what comes out and sell it. This whole hands-off approach is the key to their business, and you'll see it's behind both their biggest advantages and their most serious weaknesses. So how does this, plateau metal juice factory actually work? In this first part, we're going to get right into the nuts and bolts of how Zhihui Mining makes its money from its one single but very powerful mine in Tibet. Okay, so their whole business really comes down to three main products. First up is zinc concentrate. This is their main force, their Zhihui, making up the lion's share of their revenue. It's the stuff that goes into coating steel to stop it from rusting. Then you've got lead concentrate, which is also a nice earner, especially since it often contains valuable silver. And finally, there's a smaller slice of copper concentrate, which doesn't bring in as much volume, but it's still highly profitable. Look, this is not some complicated tech startup. It's a classic resource play, and it's dead simple. They dig up the rock, they process it to get the good stuff out, and then they sell it to a really small number of buyers. But, and this is a huge but, that simplicity is also hiding a massive risk. We're going to come back to that customer problem in a bit. All right, now for the fun part, the bull case. What makes this company a potentially fantastic investment? Well, its competitive advantage, its moat, isn't some fancy technology. No, it's literally a fortress made of ice and rock, built at over 5,000 meters high, where politics and geography create an insane barrier to entry. The company's defense is built on four incredibly strong pillars. First, they have exclusive rights to a huge chunk of land, a license that is nearly impossible for anyone else to get. Second, the altitude itself is a barrier. Just think about trying to set up a massive operation in that environment. Third, and this one is absolutely critical in a place like Tibet, they have a solid partnership with a state-owned company. And finally, the rock they're digging up is high grade, which means more metal and more profit for every ton they process. And this chart right here, this shows you that political moat in action. The ownership structure is a really smart hybrid. You've got the private founders, the entrepreneurs who actually run the show, and they're backed by this massive state-owned partner, Qingsong Health, who owns almost half the company. It's the perfect setup for navigating the, let's say, complex local business environment. But of course, it's not all sunshine and high-grade ore. No investment is perfect. For every strength, there's always a potential weakness. So now, let's switch gears, put on our investigator hats, and go looking for the cracks in this fortress of ice. The first red flag that jumps out is just how fragile this operation is. I mean, look at these numbers. In 1 year, both revenue and profit just fell off a cliff. Revenue was down by nearly half, and profit cratered by almost 2/3. And what caused this disaster? A 1-month shutdown because of cold weather and some maintenance. That shows you just how one single, totally predictable event can wreck their entire year. And here's another one you just can't ignore. There's a ticking clock. Their main profit engine, the easy-to-mine open-pit operation, has only about 8 years left. Sure, they have an underground mine that can last longer, but that is way more expensive and complicated to run. That's going to put some serious pressure on their profits down the line. The low-hanging fruit is running out. Okay, remember I mentioned their small customer base earlier? Well, this chart lays that risk bare. A whopping 88% of their sales come from just 5 customers. This is more than just concentration. It's a dangerous dependency. It gives those few buyers massive power when it comes to negotiating prices. If just one of those customers decides to walk away, the financial hit would be huge and immediate. Now, you might look at their most recent numbers and think things are bouncing back. I mean, a net profit of over 51 million yuan in 7 months? That sounds pretty good on the surface. But with a business like this, you have to remember one thing. Profit is not the same as cash. You always have to follow the money. And here it is. Here's where the story gets tricky. While they reported over 51 million in profit, only about half of that, just 25 million, actually ended up in their bank account as cash from operations. So where did the rest go?
Well, it got tied up in product they couldn't sell or was used to pay off their debts. This is a classic sign of a company with tight cash flow, even when they're supposedly profitable. All right, so we've torn apart the business, we've seen the good and the bad. Now it's time to look at the IPO deal itself. Let's look at the price, the big players who are backing it, and figure out if the valuation actually makes any sense for someone like you or me coming in now. So here are the key stats for the deal. The company's going to be valued somewhere around 2 to 2.2 billion Hong Kong dollars. Now, what really stands out here is the cornerstone investors. We're talking about big institutions that agree to buy a large chunk of shares and hold them for a while. They're taking over 41%. That's a huge vote of confidence. But on the flip side, there's no green shoe option, which basically means the bankers don't have a tool to help support the stock price if it starts to drop after the IPO. So, the million-dollar question, is the price fair? Well, after running my own numbers, I put the company's fair value right around the 2 billion Hong Kong dollar mark. That lines up really nicely with the IPO's midpoint valuation of 2.1 billion. So my takeaway here is that the pricing is actually pretty reasonable. They're not getting too greedy with this one. Okay, we have looked at everything: the business model, that incredible moat, the really serious risks, and the deal structure. It's time to pull it all together. Here is my final verdict on the Zhihui Mining IPO. This one sentence just says it all, doesn't it? Zhihui Mining has the potential to be a real cash cow, a business that just churns out cash from its assets. The problem is that cash all comes from one single source, one mine, that's operating in a fragile and really sensitive place. That's the fundamental trade-off you have to accept with this investment. So with all that said, where does Zhihui fit into the bigger picture of all the IPOs happening right now? Here's my watch list. I like to put IPOs into different buckets, and you know what? Despite all the risks we just talked about, Zhihui lands on my high conviction list. For me, the potential reward here is worth the risk, and I'm putting it right alongside another company I like, HanXBio. Now, for the most important part of all, it's time to turn all this analysis into an actual, actionable plan. Here's exactly how I'm thinking about allocating my own capital for this IPO. I see two main ways to play this. Option A is the conservative, focused approach. You skip the other stuff and put all your capital into my two high-conviction plays, Zhihui and HanXBio. The best part is their funding schedules don't conflict, so it's really efficient. Option B is a bit more aggressive. You put 80% of your money into Zhihui, but you take a 20% speculative shot on another IPO, B&K Corp. Then, and this is the key part, as soon as the Zhihui IPO is done, you immediately take that 80% of your capital and roll it straight into the HanXBio subscription. So at the end of the day, your decision really comes down to this one simple question. Do you believe that the company's powerful, high-altitude moat is strong enough to overcome those very real operational risks? Are you betting on the mountain to hold strong, or are you worried that ice is going to crack first? I hope this deep dive has given you everything you need to answer that for yourself. That's all for this explainer.